Good evening, everyone. Thank you for joining us this evening on the story of Manulife US REIT. I'm Crystal, the Community Manager at ProsperUs. Let me introduce our speaker for tonight. We have Jill Smith, CEO of the Manager of Manulife US REIT. She has over 40 years of experience as an investment management professional in Asia and Europe. Ms. Smith held a number of senior positions with leading UK financial companies before moving to Singapore in 1993. Together with us, we have Chief Financial Officer, Mr. Robert Wong, with over 20 years of experience in the finance and accounting professional, mainly in the real estate investment industry, on the Q&A panel. ProsperUs is a digital investment service catered for the millennials. We aim to provide you with the best-in-class service and to allow millennials to gain more insights on investing. We have specially curated webinar series. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. Looking to invest on the go, check out our ProsperUs app on Google Play and App Store today. Follow us on our social media like Instagram and Telegram to keep yourselves updated on the latest news. Do stay tuned to the end of the presentation, and there will be a little quiz, and we'll be giving out a pair of Manulife SkyNet tickets to the top 5 winners. So without further ado, let's start tonight's session. Jill, over to you.
Okay. Well, good evening to everyone, and thank you so much for spending this early part of your evening with the Manulife team. Like all good stories, we must begin at the beginning. And so I'm going to start by giving you some background to the Manulife US REIT, or MUST as we call it. MUST was the first US pure play office REIT to be listed not only in Singapore, but anywhere in Asia. And that was in May 2016. The Manulife US REIT, or MUST, is supported by Manulife. Manulife is a global major life insurance company, and it provides a reputable sponsor. Manulife itself has over $1 trillion of assets under management. It has 120 billion US dollars in AUM in private markets or real assets. And of course, in those real assets, you have global real estate, which you can see here down on the left-hand side. And we have strong credentials in real estate. So let's now talk about the genesis of MUST. So before the global financial crisis, Asia provided 25% of the revenues to the whole of Manulife. And post the global financial crisis, that seems like a very long time ago now, Manulife could see that Asia was recovering more quickly than its homeland of Canada or over the border in the US. So it wanted to turn its attentions and leverage on that return to growth and recovery. And so it was looking for value-add products to bring to Asian investors. And it quite quickly hit upon the fact that in Asia, many Asians know property, love property. It's they're very well versed in investing in property. So it seemed like, if you like, a marriage made in heaven to bring what was at that time the Manulife global real estate, and particularly the US real estate capability, to Asia, because it hadn't been done before. There'd been no diversification into the US in particular. And after all, the US is the largest, and still is the largest, office real estate market in the world. So as I say, a marriage made in heaven. And so that really was the genesis. And of course, since then, and over the last years up to the time of COVID, indeed, Manulife's returns from Asia have increased to over 35%. So that was the start of it all. And indeed, back when we IPO'd in 2016, the assets under management at that time for MUST was 777 million US dollars. And that has grown to the end of last year to 2.2 billion US dollars. And that's happened through acquisitions, accretive acquisitions. And we've increased the portfolio from 3 buildings trophy and Class A, so that's the very top quality buildings in office buildings in the US, freehold, and they're all office buildings. We've increased, as I say, from 3 to 12. 6 buildings have been bought from the sponsor. The sponsor had a large portfolio. I think you will have seen on the previous slide, some 62% of its portfolio is in office. It's its sweet spot. So it has been generous over the years and has found buildings that were attractive to the REIT. And we've also bought 6 buildings now from the third party. And our most recent acquisitions were at the end of 2021, when we invested in $202 million worth of new real estate. And that was funded through equity and debt. So very similar to what you might do with your own portfolio, if you like, by having some cash and then taking some debt. Over the years, we have, as you can see here, we've amassed a number of portfolio attributes in this high quality portfolio, freehold portfolio. It's very diversified portfolio right across America, as you can see. It has very strong tenant base. These tenants are what we call credit tenants. They're good for their credit, in other words. And because these are very prestigious buildings, often we have many headquarters tenants who have their headquarters in our buildings. They're listed companies, or they might be government agencies. And you can see up here on the right-hand side that the largest sectors in our buildings, perhaps unsurprising, are the wealthy finance, insurance, accounting firms, the legal and consulting firms. And they're really the sorts of tenants who go for these very top class buildings in America. They will pay top dollar for the top buildings. Of course, we've also, over the years, accumulated information in healthcare and other forms of tenants as well. And if you look below on the right-hand side, you'll see very prominent names that occupy our buildings, like the US Treasury or Hyundai Capital. That's actually the Treasury Department of the Hyundai car manufacturing company. As indicated from our IPO from 2016 to 2020, we established in our very high quality buildings a very high quality portfolio. And we can see here some of the basic criteria for the choice of acquisitions that we made. So on the left-hand side, key locations and strong fundamentals, the long weighted average lease expiry, that's the tenure of the tenants, and high occupancy. And this all in areas which were predominantly attractive from a live, work and play point of view. But over time, having established this very solid portfolio, we decided, it became clear that we needed to add some extra growth to the mix. And so we have aimed over the last 18 months to pivot into high growth markets and to also find in those markets high growth tenants. And those tenants are those these days in the tech sector, perhaps no surprise to anybody, healthcare, no surprise to anybody, but also the new knowledge economy. And indeed, these are becoming the post-COVID theme. So you have the original criteria, key criteria, plus now the post-COVID-19 themes. If we turn now just for a moment and look at the US and the US office outlook, let's just have a very quick look at this. What a difference from this time last year. The US is absolutely back in business, and we believe we're very well positioned to take advantage of this. If you look on the left-hand side, of course, we can see the headlines that have been splashed across all the news wires over the last weeks and months. Very strong economic recovery in America continues. Despite COVID surges from Omicron and Delta, GDP for the fourth quarter was a massive plus 6.9%, fiscal year 5.7%, and the outlook for 2022 is some 4%. So a very, very strong economy. Unemployment has bounced back and is at 3.9%, so that's back at the pre-COVID level. And for us, of course, what is most important is the office using unemployment is even lower at 3%. So it indicates that office life is also back in business. Now, the economy, of course, is running hot. Again, that's a predominant headline. And we've seen rapidly rising inflation, 7.5%. It's a huge amount. And so it's become very obvious that higher interest rates are imminent. So will that stop the party? Well, we don't believe so, certainly at the moment. Rate hikes are there to curb the excesses, and I think that's probably a good thing at this particular point. So I said just now that we were well positioned with MUS to take advantage of this big back in business boom, if you like, in the US. And first of all, what are the trends of this recovery in terms of office? Well, there is a flight to quality, newer and green buildings. Green buildings, very, very important. And also an influx into the Sun Belt or the magnet cities. These are the cities and locations across America where, again, you're seeing boom times growth, and those are drawing in the tenants with an acceleration of population and company inward migration. A lot of very positive reasons to go to these Sun Belt and magnet cities. So what have we been doing? Are we on trend at MUST? Well, we believe we are, because as I've already said, we have very high quality trophy and Class A buildings. We have some newer buildings. Indeed, when we bought our 3 buildings at the end of last year, one of those buildings was brand new. That was our first brand new building. And of course, as I've just mentioned, green buildings are important. And 90%, that's a very, very high level indeed, of our buildings have green accreditation. They are green buildings. And of course, we are pivoting to the high growth markets and the tenant sectors that will provide sustainable returns. And of course, our recent acquisitions are helping us with that. So what's the background environment like in US office? Let's have a little dig into that a little bit more. I've said obviously that the macro indicators, of course, continue to demonstrate broad-based momentum. And indeed, US office was really strong in terms of recovery momentum in the fourth quarter. And that despite the fact that people were still working from home because of the Delta and then the Omicron surge. So we can see up here on the left-hand side that particularly in the between the third and the fourth quarter, we saw a very high leasing volume. It's incredibly important, obviously, in your buildings to lease, and we're very pleased to see the leasing volumes overall across America increase by 13.8%. And also the tenure of the leasing has increased. Now, it's a fact that in US office, unlike here in Singapore, the tenants tend to take leases of 5, 10 years, sometimes very much longer than that. And during the early part of COVID, when firms were really unsure about the future, many had sought to renew perhaps for just a very short time, 1 or 2 years. But it's been very evident, as you can see from this line in the top-hand side, that in fact now most new tenants and tenants who are renewing have returned to these much longer tenures, so 7.8 years by the end of the fourth quarter 2021. One of the factors also in the bottom left-hand side is the tenant improvement costs and free rent that you have to give when starting leases or when commencing leases, or indeed with renewals. And it's been very much what we call a tenants market over COVID, no surprise there. The landlords really have had to negotiate very, very hard with the tenants. The tenants have been negotiating very hard with us as well. And so they have been looking for all sorts, as I say, of incentives to take up new leases and to renew. But those are now easing, and you can see again here minus 11.4% from third quarter to the fourth quarter in terms of the tenant inducements or tenant improvement numbers, and also the free rent that we have to give at the start of leases is also declining, which is a good thing. So the pendulum is swinging back to the landlords and away from the tenants once again. You can also see that the base rents and the net effective rents are also improving, and subleasing is beginning to decrease. In fact, subleasing for us was never really an issue during COVID, but it's good to see that the rest of the market is also seeing an improvement there. Looking very briefly at the overall financials and property data for the last 3 years, I think this gives you an idea that although the pandemic did definitely take its toll, there was by no means a slump in our portfolio. And you can see on the top line some of the financial numbers. Obviously, they have moved, but they're very good in terms of net property income. And on the distribution, the DPU that we pay out to investors, there has been some decline. And I think it's just worthwhile pointing out to you the reasons for that decline. First of all, again, perhaps it's pretty obvious, lower income arising from higher vacancies. I think that was to be expected. For us, lower car parking income. Pre-COVID, some 7% of our income came from car parking. And so obviously when everybody started working from home during the pandemic, that was wiped out. But we are now starting to see a recovery in car parking income as people do return to the office. There was also provisioning for expected credit losses. We had one particular retail tenant who seemed to get into difficulty at the end of 2020 and the beginning of 2021, but that was resolved. There were rental abatements that took place and hurt us. Again, unsurprisingly, that was from the food and beverage. So we have cafes and restaurants often in our buildings. So many of them obviously have struggled as indeed everybody has across the world in F&B. And so there were rental abatements. And also capital expenditure. I've just mentioned how the tenant improvements and tenant inducements increased, and also capital expenditure, again, tenants demanding all sorts of capital expenditure to make their buildings the buildings and their spaces more desirable. So those have been some of the reasons why the DPU has shown a little bit of a decline. But on the more positive side, we've been able to keep our occupancy at a very high level. You can see here at the end of 2021, we're at 92.3%, and that is way above the average for Class A buildings. And also, again, weighted average lease expiry, a very healthy 5.1 years. Again, I stress that in America, it's 5, 10, 15, sometimes more in terms of the tenure. And so again, we are certainly not seeing any great depression in terms of our weighted average lease expiry. We've been very busy on the capital management side. That's the debt management side that I mentioned earlier. And we have been able to take advantage of the much lower interest rates. So for example, our weighted average interest rate, you see at 2.82 here. At the end of 2020, that was 3.18. So you can see that we have been able to reduce that particular weighted average interest rate. We've also got a good weighted average debt maturity. Also what we've been doing is we have been changing from fixed rate loans to more flexible loans, and that is going to give us greater flexibility with the loans that we're looking for and the renewals of loans that we're looking for this year, and also possibly when we make acquisitions and possibly dispositions in the future. So you can see here over on the left-hand side, at the end of last year, having bought those buildings, we had some bridging finance. Well, we've now refinanced that, as you can see from that arrow, the 90 million in 2027. The rest of the loans that need refinancing this year are well underway, and those will be refinanced at the mid-year. I think it's very important to know when we think and we hear about the frightening prospect of interest rate rises, that, for example, in our case, every 1% increase in interest rates will only impact our DPU by 0.075 cents. So it's very, very negligible. There's some other things that we have been doing. Again, as we've been refinancing, we've been taking green loans and sustainability-linked loans. We did the first sustainability-linked loan last year. We intend to do more as we do the financing this year. And so already we have 45.1%, over 45% in green or sustainability-linked loans. This is a very big thing for us. With gearing in Singapore, gearing limits by the MAS are 50%. So you can see at 42.8%, we're actually still well below that level. And that's despite having bought so many buildings over the last few years. So that gives you an idea of what we've been up to when we've been taking loans. I've mentioned obviously already we were thrilled to bits to be able to make some acquisitions at the end of last year. Sales activity in America was really very shut down for office. but it did thaw out last year, and we were able to kickstart our growth by making 3 acquisitions. That's the first time in 2 years. And again, we were able to deliver on our promise to move into growth markets and to growth tenants. And we believe that we're clearly heading in the right direction, because on the left-hand side, you can see these lines, and you can see that musts markets and growth markets are really the ones to be in. That's the 45% on the middle line, and then also these growth markets at a much higher level, whereas the rest of the market is really trailing behind. And they have really shown a very, very good performance. And again, that indicates that we are on the right path. And you can see on the right-hand side of this page the positive impact to Manulife's to MUS's portfolio, where the growth sectors by GRI have increased now up to 12.8% growth sectors, that is. We're aiming for 20%, so we're well on the way now. And in the growth markets, we're also increasing as well. And we obviously hope to find more accretive acquisitions, but not to put pressure on our gearing. And the good news really continues, I think, in America, because here you can see in particular, we wanted to show you how, in terms of rental growth, again, very important, obviously critical to providing us with income to pay out distributable income eventually. You can see in that top strip line that in April last year, the projected 12-month rent growth was minus 2.5%. And by the end of last year, it was around minus 0.4%. But now looking forward into 2022, then the 12-month projected growth rate is actually plus 2.3%. And you can see in the dotted bar here that really there's an enormous swing from the last 12 months to this going forward 12 months. And again, some of our markets are very, very strong indeed, for example, in Atlanta, but also in our new growth markets down at the bottom, where you can see that Portland and Phoenix are showing these huge prospective rent growth. So that's very exciting indeed. And of course, very little pressure from supply, because nobody's really been wanting to put a spade in the ground to start to develop new buildings. So the supply is gradually working its way out. So that's very encouraging indeed. I've mentioned several times ESG, and ESG really is something that is very dear to our heart. It's increasingly important to tenants and landlords alike. And in 2021, we worked exceptionally hard to demonstrate MUS's commitment to ESG and to our stewardship in ESG. We held a whole week called Must Go Green of green events back in the October time. And we certainly weren't lacking in our E, our S, and our G. You can see here building resilience. These utilities, obviously we reduced our utilities. And you might say, well, how, perhaps everybody did. Well, actually, we did better than most, because on the right-hand side, you can see this GRESB Environment Building Score. When paced against 13 US peers, we were plus 7.8% above the others. So we really shone. Certainly Manulife, and certainly for MUS, it is very much a people first in the S. We've done a lot of training of people. We've got great staff engagement scores that are monitored by the external provider Gallup. And obviously we are making, even in these times of COVID, considerable contributions, not just in money, but really more importantly in terms of time to the community here in Singapore and even in America. And in terms of driving sustainable growth, again, I've mentioned our first sustainable green linked loans. We've also got very good board diversity in terms of 50% of our independent directors are female. And obviously we are engaging analysts, media, and investors and potential investors like yourselves. And that increased markedly last year. We also started our LinkedIn page. So do join us on LinkedIn if you haven't done so already. And we garnered a whole range of different sorts of accolades across this, and you could have a look at that. I think prominent amongst those were an increase in our rating in MSCI, but also on the right-hand side, we enhanced our tenants' experience through being awarded things like Fitwell certification. That's a health measure. So we've really done very well, and it is going to go on being a very, very important part of Manulife, of Must's future. So I just want to turn away from Must itself for a moment. You know, we've had quite a lot of the story already, but let's just have a little bit of the story of the US and what's been going on. And I think it's very important to look at some of these general topics of interest. And I think we want to start with working from home. Then we'll talk about the differences between the US and Singapore office, the differences between the US and Singapore in REITs, and then touch on the benefits of the tax structure to US, to REITs that are investing in the US here in Singapore. So just on this page, in the US was really a very, very early adopter of working from home. I think it was invented in America, actually, back in the 1990s. Not like here in Singapore, where frankly, I think we've all just begun to get used to this concept of working from home. But certainly before the pandemic, we can see on the left-hand side here that in America, 54% of the workforce were eligible to work from home, a very, very high percentage indeed. And that had grown very steadily over 10 years. Americans are incredibly mobile. It's very much common practice. At the peak of the pandemic, 69% of US employers worked remotely, quite happily. And today, or rather at the end of October in 2021, we can see that 76% of companies were planning to adopt the hybrid model. And I think that's really where we're going in America at the moment, and indeed perhaps across the rest of the world as well. And on the right-hand side, you can see some evidence of this, because the top two lines show a decline in total working from home or working from home exclusively. You can see a decline. And at the bottom line, very gradually, which is the working from home partially, is gradually increasing. And that seems to be the way that we're going to see work take its shape over certainly the next couple of years. Although that's not a bad thing, because of course, you know, people have to still have a desk in the office. And I think that's something that we might talk about in a minute as well. So let's now shift over and look at the key differences between the US and Singapore office. And here you can see in terms of land tenure. Well, I mentioned already at the beginning that in the US, that office buildings are freehold. Here in Singapore, of course, not so. They're all leasehold, an average of 30 years. That's a really big difference. It's always good to own your own land. And in terms of average occupancy, I've already mentioned that Class A is 83%, whereas here in Singapore, for Class A, you would have a very much higher average occupancy at 93%. The lease terms, again, we mentioned here in America, 5 to 10 years, no break clauses in that. And agents are incentivized to sign long leases. They're sort of repeatedly incentivized to sign long leases, and so they get on and do that. Here in Singapore, in contrast, of course, Singapore office is really an average tenure of just 3 years. And so is it really any surprise that when you look down on the next layer on rental escalations, that there are none in a 3-year tenure? But certainly if you have a lease for 15 years, the landlord really wants to see some sort of increase over that period. You couldn't possibly wait for 15 years. And so you will see some 2 to 3% per annum in annual rental increases, escalations. And indeed, in our portfolio at the moment, the average for rental escalations per year is 2.1%. In terms of tenant improvements, those TIs that I've mentioned, in America, renovations are funded by the landlord. That's us. That's poor old Must. And that is mainly using cash, and we'll talk about that in a moment. But here, of course, in Singapore, tenants pay for their own renovations. And again, if you're turning over every 3 years in these short leases, it really should be the tenants who are paying. Some key differences between Singapore and US office REITs now. And the one major difference really is that US REITs are really designed for growth. They're principally, that's what they're aiming for, whereas here in Singapore, S-REITs are principally looking to generate income. There is a really, really fundamental difference between the two. A lot more, obviously, office REITs in America, as you might expect. It's a much more mature market than here in Singapore, where there are just 8. The average market cap, again, you would perhaps expect this in America, for office REITs is just over 5 billion, whereas here in Singapore, even with some of the bigger office REITs, it's 1.9 billion. That's in Singapore dollar terms, so even smaller. In America, there is no cap, no limit on gearing. The sky's the limit. That gives them an awful lot of scope, those US REITs, whereas here, as I've already mentioned, it's 50%, and the average for Singapore REITs is 37.2. There's no development cap in America, but there's a development cap for REITs here in Singapore, 10% and 15%. And then in terms of distribution requirements, now here is a really major difference. Here in Singapore, let's start on the right-hand side, 90% of the distributable income has to be just that, distributed. Whereas in America, it's 90% of distributable income after retaining 50% of funds from operations. Now, what happens next is that having retained that money is then used on the next layer for CapEx and AIs. They can use their internal cash flow. Whereas here, having given out 90% of the income, then where do you get your CapEx, your funding for AIs? You have to go and borrow it. So that's a really fundamental difference and a real pressure, if you like, on the Singapore REIT. In the US, for us foreigners, there's a withholding tax on distributions of 30%. But as long as you've signed a form and completed a form called a W8-BEN, there is no such withholding tax here in Singapore. And last and not least, and again, going back to that distribution requirement, the average yield in America, because of the way that it pays out, is only 3.3%. versus the average here in Singapore for Singapore REITs, and that is 6.1%. So a very, very big difference there. And I've just been mentioning tax, and I think it's just worth just momentarily just pausing on that. We at Manulife struggled and wrestled with how to provide the very best structure tax-wise for our REIT. And on the right-hand side, you can see that what we have designed is something that produces no US corporate taxes, which would be 21%, no US withholding tax, as I mentioned before, that would be 30%, and there are no Singapore corporate taxes on domestic institutions, that would be 17%, or Singapore withholding taxes. So we've managed really to produce a structure for MUST, which really gets all of the yield into the hands of you, the investor, without tax. And of course, at the moment, we have this incredibly high distribution yield of 8.2%. So in this particular format, really S-REITs with this structure investing in the US are really at a huge advantage over if you wanted to go and invest in America, in a REIT in America, or if you wanted to go and invest directly in a building. This gives you a real advantage. Finally, I will just come to a close. There's so much to tell you. But really, what is the pathway for MUST in 2022? Where does the story go next? Well, obviously, we want to step up on further portfolio rejuvenation through accretive growth. We've obviously got this wonderful background of the surge in leasing, first positive net absorption since COVID began, transactional volumes, selling and buying increasing, and obviously we believe that office is still very relevant through the hybrid approach. We will be continuing to be laser focused on improving leasing and driving income. We're future-proofing our business through the rejuvenation and our green buildings, maintaining the growth momentum. We'll be conserving spending, stable valuations, containing gearing. We don't want to let it romp out of control while interest rates are on the rise. And we'll be continuing to explore all sorts of opportunities for capital recycling, dispositions and acquisitions. We'll be working very hard, and we believe that will all lead us to brighter days ahead and a long and illustrious story still to come.
Thank you, Jill. So I am Brenda here from the IR team. So what we will begin now is actually the Q&A. As you can see, please scan the QR code found on this presentation slide. And it will be based on the top 5 winners will be based on the highest number of correct answers. And within the fastest amount of time, we'll win a pair of Manulife Skynet tickets, which is at Jewel Changi Airport. So please, we will require you to use this QR code on this presentation or click on to the link. We will require you to key in your name that you have registered for this webinar so that we can get in touch with you. Can we get everyone to join in the quiz right now while we give maybe about 10 seconds? Yep, the names are all coming in.
Everybody loves a quiz.
Yep, there'll be 5 questions and hopefully everyone has listened to our presentation earlier.
I think it's usually at this point when I say that I hope that nobody from Manulife has actually joined the quiz as well. It sometimes happens. Everybody gets terribly enthusiastic, but they should know the answers.
Yeah. As what Jill has mentioned, staff will not
restrain yourselves.
We only have 9. We will give another 1 more minute for everyone to join in. So we only have 12 participants. Any more before we will start in a few more seconds? I'll count down to 10, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So I'll start the quiz right now. Yep, and the correct answer is May 2016. I'd just like to check if everyone managed to click onto the questions.
Yep.
Oh, there's no participant for this. Shall we restart, Crystal?
Yep, sure, no problem.
Okay, so let me just restart just to make sure everyone is ready. Okay, let's try again. So hopefully everyone is ready this time. We'll take that as our test.
The easy question.
Yeah, that's the easiest question. So just make sure everyone is ready and let's begin. All right, 86% answer May 2016. Let's see the correct answer. And that May 2016 is the correct answer. And leading in this question is Jen. Moving to the second question. So we have 60% who says 5 to 10 years and 33% who says 3 to 5 years. Let's see what's the correct answer. Yep, so it's 5 to 10 years and beyond. Now we have Da Hong, who is leading on this. Third question.
Good.
Okay, 60% say 90% of our mass portfolio are green certified. So is this true? Yep, that's the correct answer. We have Janice, who is leading in this question. Next. All right. So 71% says 45%. And you're right. Let's see who is leading in this question. It's Andy. And now we will have the final question that will determine the top 5 winners. All right. 31% says that US expected yield is 6.1% versus Singapore, which is 3.3%. And the right answer is actually US yield is at 3.3 versus Singapore, which is 6.5. Let's look at the leaderboard for the overall session. Wow. So congrats, Thomas. So after this, what we will do is just for the top 5 winners, we will get ProsperUs to reach out to you. Alternatively, please reach out directly to ProsperUs via the chat function in this webinar. However, don't be despair. For those who are not in the top 5, you can still join us in the contest found on Must LinkedIn. So just follow us. Now I'll hand over to ProsperUs to open the floor for Q&A session.
Thanks, Brenda. Congratulations to the top 5 winners. And thanks, Jill, for the very insightful presentation. So let's take a look at the first question that we have. So how is Manulife addressing the sloping downward NAV issue? Jill, would you like to take on this question? Sorry.
I'm actually going to, I've done a little bit of hard work now, so I'm going to pass over to Robert, who's been sitting very patiently there, and ask him if he might like to have a thought or two on their net asset value.
Yeah, I'll start off first. Yeah, the sloping downward NAV per unit over the past 2 years is really a result of the valuation adjustment downward. The cause of it is, as Jill has highlighted earlier, is a slide in the occupancy rates since the start of the COVID, from about 96% back in end of 2019 to about 92 end of this year. So we do take a hit, and appraisal do take note of that, and that they are made their adjustments in the evaluations. And also in the US context at the moment, it does cost a bit more money in terms of tenants improvement that we have to provide, and leasing costs that we have to incur in order to secure tenants. So all this is reflected in a drop in valuations. In turn, it affects NAV per unit.
Thanks, Robert. Can we take a look at the next question? How much tax against rent collected Manulife is actually paying within US?
Short answer is nothing. The reason for that is the way that we have structured, basically put together the holding structures. Basically, we've created a lot of tax deductions to mitigate the taxable income. So what I've done is that in the US holding structures, we have a 60% shareholders loan structures that's injected into the US REIT, and 40% in equity. So the 60% of that is shareholders loan interest, which is tax deductible, the interest income, interest expense. And the other side is that the building is accorded a building depreciations at the rate of 2.5%. So those two limbs actually is very effective in basically zeroize the taxable income. Just to be clear, it's not that there is no tax to be paid. All it is that we're able to structure in such a way that we maximize the tax deductions, whereby there is no tax to pay at the US onshore. Of course, down the road, as we look to reposition our portfolio, and that there may be some crystallization of assets in dispositions, at that point in time, some tax may become payable.
Thanks, Robert. I believe we have a few more questions. So let's take a look at the next one. Would MAS acquire assets out of US? If yes, when and what sort of assets would MAS acquire outside of US?
That's a good question. I said at the beginning that the US office, and indeed the US real estate market, is the largest in the world. And therefore, I think we have a really ample playground to find really wonderful opportunities. And so I can see no need whatsoever to move outside of the US. And the only thing I would say to you is that, of course, that doesn't stop Manulife at some point maybe launching a second REIT outside of the US, but certainly as far as MAS is concerned, we have more than enough scope across America to keep us in business and keep us very happy for a number of years to come.
Thanks, Jill. Okay, so the next question is, since IPO, every acquisition Manulife make seems to be destructive rather than improve the DPU. The more it acquired, DPU never really increased and fell instead. So as a REIT investor, what matters most is that the DPU is increasing, so not the other way around, and their fees increasing due to acquisition. And most of the acquisition, the occupancy seems to be also dropping. So would you be able to help us understand better? Joe, I think you actually highlighted on the DPU in your presentation earlier. So would you like to take on this question to reiterate your points?
Yes, so just to reiterate our point in terms of the DPU itself, and again, I think Robert's also alluded to this as well, that during the 2 years of COVID in particular, and remember, we have only been in business for just under 6 years. 2 of those obviously have been during COVID, but certainly in terms of the DPU, we certainly have been hit by increasing vacancies, by the car parking, by these ECLs, by abatements, and also by the CapEx and the TIs that have hurt our DPU. If we look at the actual acquisitions we've made, all of the acquisitions that we made, all of those 9 buildings that we bought since the IPO have all actually been accretive. And they've been accretive to the tune of, as I said, in the properties that we bought at the end of last year, plus 2.8%, equally, around over 3%. And again, it's just really a function of what's happened in the market, particularly, I think, as you say, some destruction in terms of what's happened as a result of COVID. Now, I think Robert might be itching to make a few more comments there. I can see him sitting there thinking, I'm going to add something to this, John.
No, just to supplement that, it is correct. At the point of acquisitions, all acquisitions made in the past were accretive. So if you recall, Joe has mentioned that on average, the leases are about 5 years, right? So the REIT has been going on for 6 years now. So it happened that when the vacancy surfaced, we hit a bad patch in the market, which is COVID, back in 2020 and 2021. And the leasing has been slow. So leases will naturally expire. So when we say average 5, so some obviously will be shorter than that. Usually 3 or 4 year interval after you acquire the assets, there will be certain expiries. So there are expiries every year in 2020, 2021, as well as 2022. So because of the COVID, market is a bit slow as the tenants reposition themselves, thinking what comes after COVID. Like do we need more office space or less office space? But like Gio has shared, I think the demand for office space is still robust, and we're seeing signs of improvement. So we hope that we're going to capture the market in the upcycle this year.
Thanks, Robert and Joe. Let's take a look at the next question. What is the comfortable leverage level for Manulife? Would must keep leverage less than 40% to be more prudent?
Short answer is as low as possible. Yeah, we would like to have it below 40, but every actions that we look to take upon, we got to consider it very, very prudently, how that is going to affect DPU. But the internal guideline is to not breach the 45%. And that, having said that, if you look at our second half result, after 2 years, this is the first time we see a turnaround in valuations for our 9 properties. So we hope that the worst is over.
Thanks, Robert. The next question would be, would 90% of redistributable earnings be given as dividends to shareholders for US REITs? Can one buy your shares if the buyer is not in the US or in SG, Singapore?
Robert?
Sorry, you're saying if can US investors buy mass units, is that right?
Actually, US investors can buy in our REIT. I think, all investors can buy and will enjoy the tax advantages if they are able to sign and complete the W8 BEN form, is what I would say, if that's what the questioner is getting at.
Right.
Certainly it's open to all. And indeed, we do have a fairly reasonable amount of US investors, and we didn't expect that when we first launched the REIT, but we do. And we have investors from all over the world, from Japan, from all over Asia, from Europe, from the UK, just about everywhere, and obviously a good number from Singapore.
Yeah, just to supplement that, we pay it out as long as you do your proper filing with us, because we have to report your tax status to the US IRS, right? So whether there's withholding tax on your side, that's something that the relevant investors can answer for themselves, or they have to seek separate tax counsel.
How does MAS plan to fund future acquisitions and improve distribution yields against a rate hike scenario?
Well, I think we certainly, we do want to make more acquisitions, but we must be very careful of the gearing level. Can you just put the question back up on the screen again? Would you mind? So for the future acquisitions, and again, you know, what we're hoping through that is that we're going to be in these markets, as we've suggested, that are the high growth markets, where the rentals, as you saw from that 12-month prospective rentals, such as in Phoenix in Arizona, where you might be able to achieve 5.7 or 5.9% rent growth. So we're looking really to invest and to buy in those sorts of markets, and there are many of them across America where you can still make some very handsome returns. So really, it will be those markets that we're aiming for.
Thanks, Jill. Let's take a look at the next question. The impact of rising interest rates will affect more of the US REITs or the SG REITs?
I think it'll affect, well, obviously it depends on on where you are and which particular where you're actually getting your debt from. But again, I think Robert, you're busy with underway with our refinancing for this year, so you're very well positioned to talk about this.
Well, yeah, like Jill said, it's really dependent on where's your exposure, right? If you buy US assets, which we are, that all US assets will borrow in USD, right? So depends. Some other S-REIT will have different composition, but I think I don't recollect any S-REIT that have US assets and Pan-Asia. So it's either Pan-Asia or, you know, solely focused on US or Euro. So it does appear that the US Fed is going to increase rates faster than the rest of the world. We do observe that other central governments may not actually do so. So again, it depends on where exposure is. But like Jill has explained earlier, at 86.5% hedge, only 13.5% of your loan is exposed to rate hikes, because the rest of it is fixed at a certain cost that we locked in the past years, right? So, and the impact of 1% increase is a 0.075 cents impact. It's very manageable. At 86.5, just to be clear, this is still the highest of all the Singapore office REIT. The lowest being Suntec, if I may mention, around 53%. The highest, I can't recollect which one was it, could be a call, is 85. So we're 86.5.
Thanks, Robert. Would you not agree that the high work from home rate in the US poses a threat to you? If yes, how do you plan to mitigate this risk?
Well, actually, I'm not sure I would agree with that, actually. As we said, actually, I think what is developing is very much the hybrid approach, and also because, as we've said, you know, working from home was almost invented in the US, and so, you know, for all of this time, it's certainly not impacted. This mobility that you have in America has not really affected, as I say, what was a thriving office market. So actually, I don't particularly agree with the supposition. Having said that, it is obviously in our interests, as we are guiding back and attracting new tenants, but also our existing tenants and wanting them to renew. It is definitely in our interests to make sure that our buildings are as attractive as possible. And that might mean in terms of adding amenities or greening our buildings, whatever it is really that encourages the tenants. Clearly, all of the health issues, making sure that our buildings are fit for purpose, that they are COVID compliant or pandemic compliant in whatever way is possible. So I think there are ways that we can help ourselves to help the tenants back into occupancy in the buildings. But I think hybrid route is going to really be the main route for the time being. Yeah, I think that's the answer.
Thanks, Jill. Let's take a look at the next question. In a rising rate environment into year 2023, would you opt for flexible interest rate pricing in your refinancing? I believe this question, Robert can take.
Yeah, I'm not quite sure what the question meant. I mean, we have, what I've said is that we basically box out most of the interest rates. So that's why on a blended basis, we are at 2.82. So this is going to hold for a couple of years, right? So yeah, it naturally in a rising interest rate environment, you may sort to hedge a bit more, but we believe 86.5 is a comfortable level, right? So again, this is very flexible. We will look at each situation as each refi comes along, or each acquisition opportunity. We look at our debt capital management.
Thanks, Robert. I believe we have one last question, but it's still related to the DPU, I believe. Can we just put it on the screen on the last question? On the occupancy for the building seems to be dropping.
We can't see the question, sorry.
Yeah, okay. But after an acquisition, I noticed your occupancy for the building seems to be dropping rather than improving, and you still keep acquiring to meet the requirement for the index inclusion earlier. Do you think your acquisition really benefit unit holders as your share price is not reflecting that?
Well, I think we've mentioned earlier. I take the point that obviously we have seen a drop in occupancy, and that is as much function of really of COVID rather more than a reflection on the buildings themselves. Obviously, what we are doing, and last year we did do very well. We did something like 654,000 square feet of renewals and new leasing, which was a huge amount. Obviously it is in our interest, and we're endeavouring very hard to drive up our leasing, and we'll be doing that through this particular year. What is terribly important is that we do new leasing, because it's from the new leasing that you actually start to drive up your DPU again. So that's really what we will be concentrating on in the years ahead. And we do believe that our buildings are still very attractive. We did see a very large increase in new leasing, for example, in the second half of last year. And I think we expect to see that continue into this year. And so, we do believe that there will be a strong interest in our quality buildings. And again, it's the green, the quality that we think will attract people back to us, and then the buildings in these new very high growth areas. And that's what we need to concentrate on, is get a balance through the acquisitions that we've made, and hopefully through new acquisitions as well. But we may make some disposals too, because after all, some of our buildings may be reaching their useful lifetime for us. So we may want to let some other people have some of our buildings, but we will obviously, if we sell, we'll be acquiring at the same time. And the whole idea is to drive higher growth and higher occupancy, and leading to better DPU, basically.
Thanks, Jill. We still have two more questions streaming in last minute. So let's just address this last two questions. Does MAS also capitalize on asset disposable gain sometimes?
Do we capitalize on it, Robert? We capitalize on.
I was on mute. So the question is, yeah, I mean, it depends. I think that the core considerations is like what Jill has mentioned for this position is really whether we think that the assets has served its, in a way, usefulness, and that the money could be better invested in a growth market, you know, in different market in the US, right? So I think that's the reason, and of course, if we can make a gain out of that, yeah, by all means. So yeah.
Thanks, Robert. Okay, one last question for tonight. Do US listed REITs pay 90% of profits versus SG listed US based REITs?
So they do pay out 90%, but of course they've already stripped, this is US, they've already stripped out 50%. They're holding back 50% so that they can use that for CapEx and other purposes, which is why the yield in the US is so much lower at 3.3. Whereas here it's straight, the income that we gather, we have to distribute at least 90% of that. And in fact, we have been distributing 100% of our income, and we intend to continue to do that going forward as well. And Robert's going to have a good last word.
Yeah, I'll just add on that. For US REIT, they run like a corporate. So they'll retain cash to fund AEIs or any other things, and they pay a token of dividends, right, like a corporate. Whereas S-REIT is different. By regulation, we're meant to pay out 90% of our distributable income. So how do we maximize our distributable income? Is not to have any cash retentions. So things like AEI will be funded through debt, right? So is funded through debt. So we are able to maximize the cash flow back to the unit holders.
Thanks, Robert and Joe. Sorry, just one last question from the floor.
That's great. I think it's absolutely great. I mean, it's good to have the questions.
Okay, so the last question will be, why did MAS do a private placement instead of a preferential offer recently? It punished existing shareholders.
Oh, yes. This is a question we've been asked, I think, many times. Of course, it was never our intention to punish anybody, actually, in the contrary. And we didn't set out, really, in many ways, to end up with a placement with quite a deep discount. But what happened, certainly when we were buying at the end of last year, is that we were basically dealing with 3 different sellers, and we needed to raise financing the very fastest way we possibly could. Not just because we were trying to deal with 3 different sellers and hold them together, so we needed to move very, very fast, but also, of course, we had Delta and we had Omicron. And we suddenly found ourselves in a situation where we had to, as I say, we had to move very, very quickly because the market was so volatile. We didn't know whether the bankers would withdraw at that particular point. And so the placement was really the best way. If we'd used a preferential, it would have taken us 6 to 8 weeks processing time. And so we would never have been able to withstand the volatility in the market. Equally, I've just mentioned the banks, and all fundraising has to be underwritten by banks to ensure that regardless of the outcome, we have the funds to actually pay for the transactions. And again, the banks were not going to wait 6 to 8 weeks. We were coming up, we were driving towards the end of the year, everything was slowing down in terms of the impact of COVID on the lawyers, and again, the sellers were becoming impatient. So it really became absolutely imperative that we used a placement to buy what are 3 very fine buildings, 2 of them 100% occupied, and which are in these very high growth areas. So that was why we used a placement rather than any other methodology. It doesn't mean to say that we'll use that going forward. We've used both prefs and placements, and we've only done 1 full rights issue, and that was right back in 2017.
Thanks, Joe. With that, that's the last question from the floor. Thank you so much for the insightful presentation tonight. Yeah. So for the audiences, do actually help us do a short survey. You can scan the QR code or click on the link on Facebook if you're on Facebook. Joe, would you like to do a closing for this session?
Well, I would really just like to say that it has been absolutely great to have the opportunity to talk to so many of you and to see that you have so enthusiastically asked us questions, and the questions were very incisive, and I think that that shows that many of you really already have a very good understanding of REITs, probably in Singapore, and also I hope that from what we've said this evening, you'll have a much better insight of really what's going on, A, in the US, and B, the differences between US office Singapore and also US REITs and Singapore REITs, a very different framework that we have to deal with. And I hope you will follow us in the future and see how we go through LinkedIn and watch what we hope to do, because as I say, we hope in 2022, we're going to work extremely hard to make sure that we improve on all of our numbers. And then we can hopefully meet again this time next year. Thank you.
Thanks, Jill. Thanks, Robert. And thank you, everyone, for tonight's session. Good night, everyone.
Bye.